Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
All right, welcome to the U.S. Market Update. Stocks climbed on Tuesday as investors hoped for a positive resolution on trade discussions between the U.S. and China. The Dow Jones Industrial Average added 0.25%. The S&P 500 rose 0.55%, while the Nasdaq Composite gained 0.6%, the third positive session for both indexes. Talks between U.S. and Chinese officials in London continued for the second day. The U.S. Commerce Secretary Howard Lutnick said he hopes the discussions will end Tuesday night, adding that they could run into Wednesday if need be. Now, to find out more about what's happening stateside, I've got on the line Alex Morris, the CEO of FM Investments. Alex, thanks for coming back on the show.
Thanks for having me.
Yeah, first and foremost, I want to touch base with you about your thoughts on the U.S.-China trade talks. On day one, there were talks about the reintroduction of exports of critical minerals. What was the big news on the second day of talks?
Well, I think the big news is we didn't go backwards, which I think was a primary concern for most of us watching from the sidelines. The China-U.S. trade discussion has been less a discussion than a public shouting match from time to time. And it is clear that the U.S. is now willing to negotiate. We've seen a handful of 90-day extensions. We've seen some thawing in rhetoric. We saw some action, positive action with U.S.-Mexico talks, sort of all leading to the fact that I think the administration is now getting serious about actually trying to solve this problem. The problem for the administration now is how do you solve this problem where you get some amount of tariff revenue, and will that be enough to offset the president's spending plans in the U.S.? And the only country large enough to meaningfully do that left at this point is China. And we're going to find out if the president can balance his spending demands with tariff revenue that may or may not materialize.
Yeah, just curious to know what the president's recent actions suggest about how trade and monetary policy are being used, it seems, for political messaging rather than economic strategy. Is that a fair point?
That's absolutely correct. And tariffs for a long while have been a signal for political messaging more so than an economic gain. The last time the U.S. tried to use tariffs for economic gain, the Great Depression followed not long after. And I think we've learned our lesson from that. But the real discussion on tariffs really should be about trade imbalances. And it is clear that some imbalances have become unsustainable for a variety of reasons. Unfortunately, tariffs seem to be the only way to solve that problem, and they are very much a blunt instrument that here was used perhaps too bluntly.
So how are markets internalizing all of this volatility right now?
Markets have been remarkably smooth. Even during April, there was a very orderly wind up of volatility and then wind down of that volatility. Nothing broke. But I think now markets have become, particularly U.S. markets, relatively inured to this process. It's now going to take substantially good or substantially horrible news for them to really react. The sort of shock and awe of early part of January and February has given way to, hey, we remember this from season one of Donald Trump's presidency. Don't believe what is tweeted. Believe what you hear 6 months later and actually becomes policy.
Alex, I want to touch on jobs data as well. It's kind of been all over the place. Is there a coherent trend here, or are we in a bit of a statistical fog?
Well, the ADP data has never been terribly reliable anyway, so I wouldn't add that to the mix. But the BLS data was better than expected, but not a blowout. And I think many of us were predicting that. But the general trend is revisions remain down, and the economy is starting to slow. Not as much as perhaps the president would tweet about, but you are seeing now a consistent set of cracks across the ecosystem of data that's telling us something is going to break at some point. It's just not today.
Yeah. How might the recent data that's come out on the jobs front influence the Fed's interest rate meeting that's coming up on the 17th, 18th of June?
I don't think it has any material impact to the June meeting. I think it does have material impact to the September meeting. The Fed's messaging for June has probably been printed and in the can for some period of time, and nothing that we've seen would give them any reason to change that. The question for them now is, how do they orchestrate what would be a very well pulled off soft landing in December between now and then, and how bad will things get before we go to Jackson Hole?
Yeah, if the Fed does pull off the soft landing that you've just referenced, will it finally silence the critics, or is that just wishful thinking in this current political climate?
I think it will silence many of the economic critics that it was possible. And let's not forget the central banking experiment is still in its relatively early stages of determining, can we do this? But it'll never silence the political critics who want to overly politicize the Fed. The Fed is actually made up of folks who are appointed by a political being anyhow, and it will only prove that everyone was right and everyone was wrong as long as they said so. So unfortunately, Jay Powell's job may be safe and he may serve out his term without issue, but his predecessor will be victim of the same, if not worse, sideline jeering, and will unfortunately have to learn to deal with it.
Yeah, just continuing on that note, is the re-escalation of the criticism that Donald Trump has thrown towards Jay Powell and the Fed a political miscalculation in your eyes, or a strategic distraction?
I think many things the president has done, we would have said were political miscalculations. However, he seems to pull them off for a wide swath of the population. He was elected president of the United States twice. And every time he's done some of this, I would have told you that was a major foot fault. It doesn't seem to injure him, though. He's developed an ability to sidestep that. I think it is consistent with his persona to the public, right? The name calling and handful of other items that are trying to be Monday morning, quarterbacking this exercise. But it never seems to really stick, and that tends to be true of most presidents, particularly earlier in their term. You can make a few mistakes, you can say a few silly things, and as long as things are fine around come the midterms or time for re-election, which isn't an option, obviously, for Donald Trump, everything seems to be forgotten. But that said, Donald Trump has a strange ability to lean into these otherwise miscalculations for others and seem to thrive for it.
And the other fallout that's drawn a lot of news headlines is the one between Trump and Elon Musk. Do you think that has any actual investment implications, or is it just theater? We did see Tesla stock dropping 14% last Thursday, rallying again, up 3% the following day. But yeah, is there any kind of long-term concern to this fallout?
I think it was a very well-predicted breakup. And it was a question of how soon, not even an if or a when, but just how quickly. Perhaps faster than maybe we would have guessed. From an investor in Tesla and Elon Musk universe, I don't think this has much to do in the long run, assuming it doesn't bubble over and the president become vindictive and try to cancel some of the SpaceX contracts or the more lucrative parts of the Starlink business and the new military version of it. And I think cooler heads will prevail long before that. But let's not forget, Tesla has long been a very volatile stock. So a 14% move based on some news catalyst shouldn't be terribly shocking, and it should be something that Tesla investors for the long run will certainly well remember, because it has had much bigger moves in the past and is likely to have much bigger moves in the future.
Yeah, that's a fair point. Alex, against the backdrop of everything we've discussed, how should investors be positioning themselves in this current environment?
We're telling investors don't buy the dip yet. We think it's probably fine to venture into the equity markets for the time being. But, with the deterioration coming, we don't think that the Fed will come to the rescue immediately. So you're going to see some rockiness, and you need to be willing to stomach that. Short-term bonds, particularly short-end sovereign bonds in the U.S. and elsewhere, still have attractive yields. You're still going to do pretty well there. And we like folks venturing out into a little more duration assets as the Fed prepares to cut rates. That's the type of bet you want to be early in on, because showing up on time tends to be a little too late for most of the return.
Yeah, we've got the split between T-bill and RBill and Chill, a strategy that has appeal that you've mentioned to us in your notes. What's the thesis behind it, and how does it compare to traditional inflation hedges like gold or TIPS?
We like the ultra-short TIPS market because you get all the benefit of TIPS, which is the inflation protection guaranteed by the government, without any of the duration that tends to injure you when inflation needs to be addressed by the Fed. So we like that space where you can separate the two and get that CPI participation. And whether it's RBill for CPI participation or T-bill for just exposure to the short end of the market, we like the yield that you're going to see on a regular basis, and we like the simplicity of staying short and staying liquid.
You also have mentioned to us that high yield spreads are widening. Is now the time to wade in or wait for better risk reward setups?
We like the high yield market today and makes sense to wade in. The traditional trigger is when spreads hit over 700, which they tend to do very quickly. We like to warn folks that it's nice to be able to predict that top. It's very hard to do. We do like the return profile there. In particular, of the larger, more liquid names, we like the ability to get in and get out of those. We're worried more about the lower quality end of the high yield market where defaults are starting to tick up and where if you change your mind that you may not want to be holding this asset, it's a lot harder to sell for fair value.
All right, Alex, thank you so much for giving us your time and your insights today. It's a pleasure having you on the show, and we welcome you back soon in the future.
Thank you.
Thank you. That was Alex Morris, CEO of FM Investments, and you're listening to Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.